Welcome. This is my basic bookkeeping crash course. I've done this course in Bahasa, but today I will be recording it in English. Okay, these are all the items that you will be learning in this crash course. Don't worry. It might look a bit technical, but I'll break it down to make it easy. So even though if you don't have any accounting background, you can still do the accounts yourself. Okay, in this crash course, you will be learning single entry bookkeeping. Single entry bookkeeping is quite simple. You need not know about the debit and the credit. All you need to know is in and out. In will be all your income and out will record all your expenses. So if you're not familiar with computer, with Excel, then you can just buy a ledger book or an exercise book. Or if you're familiar with Excel, then you can do it on the computer using Excel. Okay, under the single entry bookkeeping, which is also known as cash register, so you have to do in 6 columns. Okay, the first column will be for date. Second is for descriptions. Descriptions will be the name of person from whom you're receiving the money or to whom you are paying. So that is recorded under descriptions. Okay, in will be the amount of money that you are receiving, and out will be the amount of money that you're paying out. Okay, then you have the total column, or also you can call it as balance. Okay, and then in the remarks column is like a note form. If there is something that you need to put down in case to remember for the future, so you just put it down under the remarks column. Okay, this is a single entry bookkeeping transaction that has been made for 1 week. Okay, 1st December, so we put in cash as capital 1,000, so the total gives 1,000. And on the 2nd December, okay, we spent 200 to buy furniture, so the money has decreased to 800. And on the 3rd December, okay, we purchased inventory, stock barang, so for 500, so the amount has also decreased to 300. And on the following day, so you have cash sales 250, so amount will have increased 300 plus 250, so you have 550. And you also have another cash sales, so the amount has also increased. And on the following day, okay, so we purchased top up for a handphone for 20 ringgit, so the amount has decreased by 20, so now it's 630. And on the 7th, we purchased stationery for 30 ringgit, so the amount now is 600. Okay, at the very last row, these are totals, so it just helps us to check whether the amount that we have calculated is correct. Okay, this slide is the same as the previous slide. It's just that I would like to emphasize that we recognize income when you receive and expenses when you pay, being a cash accounting, meaning we only deal in cash. So anything coming in, we will recognize as income. Anything going out, we will recognize as expenses. Okay, but later on, there will be other items, okay, like capital. Capital is not an income, okay, it's equity. So that one I will go further in the following slides. Okay, in this slide, we will have to understand the difference between asset, liabilities, and equity. Okay, assets are items we purchase because we need to use it for the business. Okay, for example, we purchase furniture, we purchase cash register and aircon. Okay, we are not selling it. Okay, because maybe we are a trading company, we sell books, but we still need furniture, cash register to run the business. So these are assets. Okay, liabilities. Okay, liabilities are money that the company owes to others. Example, we took out bank loans, or we purchase item on credit, so we have creditors. And maybe we have personal loans. In order we need to expand the business, so we took out personal loans. So those are liabilities. Okay, equity. Equity are the amount of cash or personal assets that are transferred into the company. So when we wanted to start the business, so we have to put in some money, or if we have assets that we need not purchase, maybe we have a van or we have furniture, so we put it into the business as our capital, but it becomes the assets of the company. Okay, these are simple equations that we need to understand to help us to balance the books. Okay, because assuming that we do not have any accounting backgrounds, okay, so we do not know the debit credit, but we can still do the accounts. All we need to know is these simple equations. Okay, it's like a modern maths formula. Okay, asset equals liabilities plus capital. Okay, for example, okay, if I start a company, okay, I put in capital 1,000. So 1,000 I put in as cash into the business. So cash becomes asset. So asset is 1,000 equals liabilities. No, we don't have any liabilities, so it's 0, plus the capital that I put in, which is 1,000. So 1,000 equals 1,000. Okay, so if we were to put liabilities, okay, we move liabilities to the left hand side. Okay, so we move asset to the right hand side. So in order to make it balance, so liabilities equals capital minus assets. Okay, remember just now, do we have any liabilities? No, we don't. So capital is 1,000 minus asset, which is the cash that we put in 1,000. So liability is nil. Ta-da! Okay, simple, right? Okay, the same thing if we move capital to the left hand side. So you move back liabilities to the right hand side. So capital is 1,000 equals asset 1,000 minus liabilities 0. Okay, easy. Okay, this is a simple equation. Okay, I'm sorry again, it is in Bahasa. Okay, but I think it will be easy for you to understand. Just look at the equations at the bottom. So it just the story is I put in cash 10,000 to start a business. Okay, from the business aspect, so 10,000 becomes the cash of the company, and it is the equity of the shareholder, which is me. Okay, so asset is 10,000 equals liabilities. Nope, we don't have any liabilities, and I put in 10,000 as capital, or also known as equity. Okay, this is another exercise, just an expansion from the previous slide. In this case, we have a liability. Okay, the story is I put in 10,000 into the business, and I bought furniture on credit from Mr. Lim for 3,500. Okay, so remember previously I put in 10,000 as my capital, so it becomes a 10,000 cash, which is asset, to the business, and then I purchase furniture. Furniture is asset for the business, costing 3,500, but I purchase it on credit, so it becomes a liability. So if you put it under the formula, so asset, so we have 10,000 cash plus 3,500 the furniture, which is still an asset. It gives 13,500, and it is equals to liability. 3,500 we purchase on credit, and the equity, the capital that I put in 10,000. So 13,500 equals back to 13,500. Okay, in this slide, we're going to learn about the income statement. Okay, the income statement is also known as the profit and loss account. Okay, this income statement will show the profit or loss of your business during a particular period. So if you do your accounting, your closing every month, so you have to make sure that you close it every month, so it will be easier for you to make a comparison between the first and the second month and the third month. Okay, it is advisable to do that rather than to wait until year end, because by then it will be too late for you to handle maybe your overspending on certain amount that if you had known it earlier, you could have controlled it and you can save some money for the business. Okay, what goes into the income statement? Okay, income statement will take into account the company's revenue, expenses, and costs for a particular period. Okay, so remember, this is a profit and loss account, so it only takes into account your income and expenses. Okay, assets, nope. Liabilities, nope. Equity, nope. Okay, so that item, those three items will go into your balance sheet. So that will be another slide. So the income statement only takes into account, remember, your revenue, expenses, and any cost for this particular period. Okay, I will explain more what's the difference between expenses and costs. Okay, revenue are also known as sales. Okay, money received for the sales of the company's goods or services. Expenses. Okay, expenses are operating expenses, okay, that you spend in order to run the business. Your wages, salaries, the office expenses, the stationery. Okay, these are operating expenses. You need it because you need to run the business. Okay, cost. Costs are value of items that we purchase for the purpose to make sales. Okay, let's say if we run a bookstore, so we need to buy books to sell. Okay, these books comes from overseas maybe, so when you have it coming from overseas, so maybe you have to incur custom duty, import charges, and the transportation. Okay, all of those are costs. Okay, so it goes into the cost of the books. So these are categorized as costs. Okay, this is a simple example of an enterprise income statement. Okay, so I'm doing it as a crash course for an enterprise. Okay, this is meant for a new entrepreneur. Okay, so you can do this on your own. Okay, maybe you don't have enough cash to appoint a bookkeeper or an accountant, so you can do it on your own until the business grow. Okay, this format is easy. Okay, so you just need to know all the cash is lumped on top. Okay, you have your cash sales and credit sales. Okay, you add it up, then you get your total sales. Okay, the cost of sales, remember from the previous slides, cost. So these are all items and its cost that we have to incur on the item that we need to sell back. Okay, so these are considered as cost of sales. And then you have your expenses, the operating expenses. Okay, so look here, your total sales, you minus your cost of sales, then you have your gross profit. Okay, this gross profit have to minus with all the expenses incurred. So then only it will give you either you are running on a profit or a loss. Okay, in this slide, I just want to emphasize on the item that goes into the income statement. Okay, so the revenue, the expenses, and the cost for that particular period. Okay, so if you are recording for the month of December, you will only take into the account the revenue, the expenses, and the cost relating to that month only. Okay, this is also just a recap. Sales could be cash sales or credit sales, and expenses could be expenses paid by cash or acquired by credit. Okay, this is one of the important items in the income statement. Okay, and it also proves the profit and loss situation of the company. Okay, so that is cost of sales. Okay, when you start a business, you might have a certain amount of stock to sell in the beginning. So this is called opening stock. Okay, and then during the period, say 1 month or 1 year, you would have purchased more items to sell. So this is recognized as purchases. Okay, at the end of the month, when you close the account, you checked and discovered there are still certain amount not yet sold. So this amount will be called closing stock. Okay, so when you close the accounts, every month you have to check your closing stock. It's either you can do it physically, or if you have it on the computer, okay, you can have it closed on a certain date, say every 30th, for you to know the closing stock of the business, because this is one of the important items that you need when you close your account. Okay, this is a format that you can follow whenever you need to close your account on the calculation of your cost of sales. Okay, so your opening stock, for example, is 5,000. Then you add your purchases, 3,000. So your total cost is 8,000 now. Okay, the closing stock, because you need to know how much you have sold. Okay, so the easiest is to check your closing stock. So you check your closing stock and you discover you still have 2,000 balance. So your cost of sales is 6,000, or in other words, the amount of items that you have already sold is 6,000. So we're coming to the end of the course. So there's still a lot of things that you need to know, but I feel that these are most of the important things that as a new business you should know, that you can do it for yourself. So hopefully it has been helpful for you, and I hope you stay in touch, and if you have any problems or things that you need to ask me pertaining to the accounts of your business, you are most welcome to WhatsApp me or message me. Thank you. Bye.